Hello, this is the 26th episode of What Would Peter Lynch Do, which explores the wisdom of legendary investor Peter Lynch. Today, we're really getting into something fundamental. We received a great question from a listener, and it hits on a core concept for anyone starting out. They asked, and I'll quote it directly, PER is the most widely used indicator when judging stock prices in the U.S. stock market. Why has this indicator become the most common indicator for explaining stock prices? And PER is also used in analyzing the stock prices of each company, but can you judge whether the current stock market is overheated or not by looking at the average stock price PER of the entire stock market?
Hmm, that's a fantastic question. It really gets to the heart of it. How do we figure out if a stock price is fair? So our mission today is to unpack this price to earnings ratio, the PER. We'll break down why it's so popular, how it can, maybe give us clues about the whole market's temperature, and importantly, how someone like Peter Lynch might suggest you use it when looking at individual stocks.
Absolutely. PER is kind of the classic starting point, isn't it? Basically, it's just the stock's current price divided by its earnings per share, or EPS. Think of it like this. It tells you how many times the stock price is formed compared to the company's earnings. Or maybe simpler, it answers the question. How much money do I have to pay right now to get $1 of this company's yearly profit?
Okay, that makes sense. But why PER? I mean, there are tons of financial numbers out there. Why has this one become like the main headline indicator for so many people? What makes it the rock star?
Well, I think a big part of it is that it's pretty intuitive, right? On the surface, anyway. It gives you a quick feel for whether a stock price seems, reasonable or maybe a bit expensive compared to the actual money the company is making. A low PER often makes people think, maybe this is cheap, a potential bargain.
Yeah.
But for investors like Peter Lynch, it wasn't just about a low number. It was about understanding why the number was low or high. What's the story? And fundamentally, the dominant view in finance is that a company's real value, its intrinsic value, comes from its ability to earn money. Because those earnings are what shareholders ultimately get back, either through dividends or because the company reinvests them to grow bigger and more valuable.
Right, earnings are king, essentially.
Exactly. So a ratio tied directly to earnings makes a lot of sense as a core valuation tool. Plus, it's really versatile. You can use it to compare companies, and this is important, companies in the same line of business.
Ah, like comparing two different coffee chains, but not a coffee chain and a software company.
Precisely. If two similar companies have similar growth prospects, but one has a PER of 10 and the other 20, that immediately flags something for you to investigate. Is the one with the lower PER undervalued? You can also compare a company's current PER to its own history. Has it typically traded at 15 times earnings, but now it's at 25? Why? And it scales up, too. You can look at the average PER for an entire industry, or even, as the listener asked, the whole market.
Okay, so that brings us to the second part of the listener's question. If we can use it for one company, can we use this average PER to tell if the entire stock market is, running a bit hot, getting overheated?
Yes, we can, and it's a very common way to take the market's temperature, though it's definitely not a foolproof thermometer. What analysts do is calculate the average PER for a broad market index, like the S&P 500. This gives you a snapshot of the market's overall valuation level. Then, the key step is comparing that current average PER to its long-term historical average.
And what is that historical average typically?
Generally, for the S&P 500, it's cited as being somewhere in the range of 15 to 20 times earnings. Some analysts might narrow that down a bit more, maybe 15 to 18 times, as a more conservative long-term benchmark. So if the current market PER is way higher than, say, 18 or 20,
That suggests things might be getting overheated.
yeah,
People are paying a lot more for each dollar of earnings than they usually do.
exactly. It could mean investors are expecting really strong future growth. Maybe they're just overly optimistic, or perhaps other factors are at play. We saw this dramatically during the dot-com bubble, late 90s, early 2000s. The S&P 500's PER went above 40 times. That was a huge warning sign that prices were detaching from the underlying business reality.
Wow, 40 times. Okay.
And conversely, if the market PER drops significantly below that historical 15-20 range, it might suggest the market is undervalued. Maybe investors are too pessimistic. But there's a really important caveat here. You can't just look at PER in isolation. Peter Lynch would definitely emphasize this.
Context matters, right.
Absolutely. You have to consider the broader economic picture. For example, interest rates are crucial. If interest rates are super low, like they have been for periods recently, bonds don't pay much. That makes stocks look more attractive in comparison, even if their PERs are a bit higher than average. Low rates can justify a somewhat higher market PER.
Okay, so low rates push people towards stocks, bidding prices up relative to earnings.
Right. And expectations about economic growth also play a big role. If everyone expects the economy and corporate profits to boom, they'll be willing to pay a higher PER today in anticipation of those future earnings.
So it's complex. It's not just one number tells all.
Definitely not. These factors provide context. They don't give a blank check for any PER level, but you need to weigh them.
This leads perfectly into that specific number their listener mentioned, 22 times PER. We hear these kinds of thresholds sometimes. What's the logic behind saying 22 times my signal overheating? Is that a reliable rule?
Yeah, it's interesting how these numbers get anchored in discussion, isn't it? First off, Peter Lynch would probably be quick to say there's no magic fixed number that's always appropriate for the market's average PER. It shifts.
It's always changing based on those economic factors you mentioned.
Exactly. But the idea that 22 times PER could be a sign of overheating, well, there's some logic there, especially if you're taking a more cautious view. The main reason is simply that 22 is noticeably higher than that long-term historical S&P 500 average of, let's say, 15 to 18 times.
So it's already stretching above the typical range.
Right. A PER of 22 implies that investors are already baking in quite a bit of optimism about future growth. The price reflects high hopes. And a high PER like that, it's not just a number, it carries risk. It means expectations are elevated. Peter Lynch always stressed understanding what you own and why. If the market PER is high, you have to ask, are these high expectations for future earnings realistic? What happens if that growth doesn't materialize, or if interest rates go up, or the economy slows down?
Then those high PER stocks could fall sharply because the justification disappears.
Precisely. The higher the PER, the less room there is for error or disappointment. You're paying a premium, and that premium needs to be earned through strong, sustained growth.
Okay, so where are we now? Do we have recent numbers for the S&P 500's PER?
Yes, and looking at recent data is helpful. So as of around late 2024, the trailing PER, the S&P 500 that's used in the past 12 months of actual reported earnings, was roughly 27.99 times.
Wow, okay, 27.99. That's quite a bit above 22.
It is. Now, there's also the forward PER, which uses analysts' estimates for earnings over the next 12 months. As of mid-June 2025, looking at estimates for December 2026 earnings, the forward PER was around 21.76 times.
Ah, so the forward PER is lower, closer to that 22 mark. What does that difference tell us?
It tells us analysts expect earnings to grow significantly, which would bring the PER down from that high trailing number. The trailing PER shows where we were based on past earnings, while the forward PER shows where the market thinks we're going based on anticipated earnings.
So the market is currently pricing stocks based on the hope of strong future earnings growth.
That's a fair interpretation. Both numbers, 27.99 trailing and even 21.76 forward, are above that historical 15-20 average. So if you consider 22 times to be potentially overheated, then a trailing PER in year 28 certainly looks elevated. It suggests the market has high expectations built in, perhaps supported by factors like AI optimism or past low rates, but it warrants caution. You need to believe that future earnings growth will indeed be strong enough to justify these levels.
Okay, that's a great breakdown for the overall market. Now let's zoom back in. How does all this translate when I'm looking at one specific company, say my favorite cookie company again? I can't just slap the market average on it, can I?
No, definitely not. Judging an individual company's PER is much more about context and comparison. You never look at a single company's PER in a vacuum.
Comparison is key, you said earlier.
Absolutely. There are really three main things you need to compare it to. First, like we touched on, compare it to other companies in the same industry or sector. Your cookie company. Let's say company A has a PER of 10x, company B is 12x, company C is 8x. Assuming they're truly similar businesses.
Then company C, with the lowest PER of 8, might be the one worth investigating first. Potentially undervalued compared to its peers.
Exactly. Or maybe company B at 12x is a bit pricey relative to the others. But the key is comparing apples to apples cookie companies to cookie companies. Peter Lynch was brilliant at finding overlooked gems by doing just this, comparing similar businesses within an industry.
Makes sense. What's the second comparison?
Second, compare the company's current PER to its own historical PER. Let's say your cookie company A usually trades around 8 times earnings. But this year, maybe because everyone suddenly loves their new organic cookies, the stock price has shot up, and now its PER is 15 times, even though earnings haven't dramatically changed yet.
So the stock has gotten more expensive relative to its own track record and its current earnings. That could be a sign of maybe temporary excitement or overheating for that specific stock.
It could be, yes. It's a flag to investigate why it's higher than usual. Conversely, if the company's earnings did soar but the PER stayed low, that might suggest the market hasn't recognized the improvement yet a potential opportunity.
Okay, peers and history. What's the third comparison point?
This one is arguably the most important and very much in the spirit of Peter Lynch. Compare the PER to the company's future growth potential. Imagine Cookie Company A has a PER of 20. Seems high, right? But what if they just launched a revolutionary low-carb cookie that's flying off the shelves, and analysts expect their earnings to grow fivefold over the next 5 years?
Ah, so the high PER might be justified because you're paying for that massive expected future growth.
Precisely. Now compare that to Company B with a nice low PER of 10, but maybe they have no new products, flat sales, and fierce competition. Peter Lynch would probably say Company A, despite the higher PER, might actually be a better investment if you believe in that growth story.
So a high PER isn't always bad, and a low PER isn't always good. It depends on the growth.
You got it. You're
Okay.
essentially buying future earnings. A high PER for a company with explosive, sustainable growth can be perfectly fine. A high PER for a company with no growth is, well, usually a recipe for disappointment. It's like Peter Lynch said about paying a fair price for a great company rather than a low price for a mediocre one.
Mm.
Let's use a couple of quick examples. An ordinary manufacturing company, A's Factory, might normally have a PER between 8 and 12 times. If it's trading at 10x now, that seems appropriate. If it suddenly jumped to 18x with no real change in its business outlook, you'd definitely call that overheated, maybe even a mini bubble in that stock.
Right.
But now take a fast-growing IT company, B Future Tech Copen, Ltd. These kinds of growth stocks often trade at much higher PERs. Maybe 25 to 40 times is considered normal because people expect rapid expansion. So if it's currently at 30x, that might be perfectly appropriate for its type.
But if that company suddenly jumped to 80 times PER,
Then yes, even for a growth stock, 80 times is extremely high. It's highly likely to be overheated. It suggests investors have gotten way too excited, and the price is probably detached from realistic future prospects.
got it. So for an individual stock, I need to ask, how does its PER stack up against its peers? How does it compare to its own past? And critically, does the PER make sense given its likely future growth?
That's the framework. TER is a fantastic compass, a really good starting point for valuation, but it's just one instrument on the dashboard. Relying only on PER can definitely lead you astray.
Okay, that's a perfect lead-in. If PER is the compass, but not the whole map, what else do we need in our investment toolkit? What other numbers and factors should someone, especially someone new to this, be looking at?
Great question. Yeah, you need more tools. Sticking with the numbers for a second, besides PER, a few others are critical. First, EPS, earnings per share, which we already mentioned as part of PER, but you want to look at the trend. Is EPS actually growing consistently? That's a sign of a healthy business.
Right. The E in PER needs to be solid and ideally increasing.
Exactly. Then the growth rate itself, how fast are sales and profits actually increasing year over year? For some companies, especially newer ones or tech companies, this growth rate might be even more important than the current PER. High growth can justify a higher PER, as we discussed.
Okay. EPS growth, sales growth, what else?
PBR, the price-to-book ratio. This compares the stock price to the company's net asset value per share, basically, what the company owns minus what it owes on a per-share basis. PBR can be useful for companies that aren't profitable yet, so PER doesn't work, or for assessing value in asset-heavy industries like banking or manufacturing. A PBR below 1 sometimes suggests the stock is trading for less than the company's net assets, which could be a bargain, but you need to understand the quality of those assets.
Interesting. Assets matter too.
They do. And don't forget dividend yield. If a company pays a dividend, that's cash directly returned to shareholders. Consistent growing dividends often signal a stable, mature, and profitable company. For income-focused investors, this is obviously key.
So EPS, growth rate, PBR, dividend yield. Those are some key numbers beyond PER.
Yes, those give you a more rounded numerical picture. But Peter Lynch would hammer home that numbers aren't everything. You have to look at the qualitative factors, too.
The story behind the numbers.
Precisely. First, understand the business model. What does this company actually do to make money? Do you understand it? Does it seem sustainable? Is it a business with a future, or is it maybe tied to a fad?
Like, can you explain it simply?
If you can't explain it simply, maybe you shouldn't invest in it. That's a good rule of thumb. Second, look for a competitive advantage, what Warren Buffett calls a moat. Does the company have something special that protects it from competitors? Like unique technology, a super strong brand name people trust, patents, or maybe just a dominant position in its market. This moat is what allows for long-term profitability and growth.
Okay, a strong
It's
defense.
essential. Third, check the financial health. Look beyond just earnings. How much debt does the company have? Too much debt makes a company very risky, especially if interest rates rise or business slows down. Do they have enough cash?
So a solid balance sheet is important.
Very. And finally, perhaps the most subjective but critical factor, management. Who is running the show? Are they competent? Do they seem honest? Do they have a clear vision for the future? Bad management can ruin even a great business.
That's a lot to consider. Business model, moat, financial health, management, plus all the numbers.
It is. But investing is ultimately about trying to predict the future success of a business. The more of these pieces you understand, the better your chances of making a good decision. You're building a case piece by piece.
It really does feel like there's so much to learn and track, which brings up a crucial point. For us regular folks, individual investors without huge research teams, how can we possibly keep up and make smart decisions? It feels overwhelming. Peter Lynch must have had advice for this, right?
Oh, absolutely. This was central to his philosophy. He believed individual investors actually have advantages because they aren't caught up in the Wall Street herd mentality. His advice wasn't about complex formulas. It was about common sense, selection and focus, and sticking to your own principles. It's advice even a middle school student could start applying.
Okay, I like the sound of that. Simpler is better.
First, and perhaps most famously, invest in what you know. Use your circle of competence, as Warren Buffett calls it. Peter Lynch made a fortune for his Magellan Fund investors by focusing on companies whose products and services he saw and understood in everyday life. He'd say focus on companies that make products or provide services commonly seen around them.
So leverage your own experience. If you love video games, maybe look at gaming companies. If you work in healthcare, maybe you understand those businesses better.
Exactly. Use your hobbies, your job, your major, the brands you buy, the stores you shop at. You often have insights into these businesses, their strengths, weaknesses, competitors that a Wall Street analyst looking at a spreadsheet might totally miss. Start there.
Okay, stick to what I understand. Makes sense. What's next?
Second, see the big picture. Invest with a long-term perspective. Peter Lynch always stressed that buying a stock means becoming a part owner of a real business. It's not about quick trades or timing the market perfectly.
So think like an owner, not a gambler.
Precisely. Think in terms of years, not days or weeks. At least 3 to 5 years, maybe even longer. Don't panic sell just because the market has a bad week or month. Look at the underlying business. Is it still strong? Over the long run, the stock price tends to follow the company's earnings and success, and those inevitable market downturns or crises. They can actually be great opportunities to buy shares in excellent companies at lower prices if you have that long-term view.
Right, patience is key. Don't get shaken out by noise.
Spot on. Third, you don't need to track everything. Focus on just a few key indicators. You don't need to be an expert in dozens of ratios. For most companies, if you understand the PER in context, look at the EPS growth, and check the revenue or profit growth rate, you've covered some really important bases. Keep it manageable.
Okay, focus on a few vitals. PER, earnings growth, maybe overall sales growth.
That's a great start. Fourth, diversify your investments. Peter Lynch famously ran a highly diversified fund. The old saying holds true: don't put all your eggs in one basket. Owning shares in just one or two companies is risky. If something goes wrong with one of them, it can really hurt your overall portfolio. Aim to own shares in at least 5 or more different companies, ideally across different industries.
So maybe some tech, some consumer goods, maybe a financial company. Spread the risk around.
Exactly. Or an even simpler way to get instant diversification is through an ETF, an exchange-traded fund. Something like an S&P 500 ETF automatically gives you a tiny piece of 500 different large U.S. companies. It's a great option, especially when you're starting out.
Diversification is protection.
Got it.
What's the last piece of advice?
Fifth, study consistently and be skeptical. Investing isn't a one-time decision. It's an ongoing learning process. Keep up with news about the companies you own or are interested in. Visit their websites, especially the investor relations section. Companies publish a lot of useful info there. And crucially, be skeptical. Don't just buy something because your neighbor did or because you read a hyped-up article. Ask why. Does this investment make sense based on your understanding and your principles? Think for yourself. Peter Lynch was a master at questioning the consensus view.
Know what you own, think long-term, focus on key metrics, diversify, and keep learning and questioning. That feels achievable.
It absolutely is. And maybe the most important thing Peter Lynch implicitly taught is this: don't overthink it to the point of paralysis. Investing isn't some secret club only open to finance wizards. Even starting small, putting a little bit of money into a company you find interesting, one you actually understand, and maybe even use as a customer, and then just watching it, seeing how it operates, how it grows, how the market reacts, that direct experience can be incredibly valuable. It connects you to how business actually works, but just always remember the golden rule, especially at the beginning. Start with a small amount of money you can afford to lose. That's not just investing wisdom, it's life wisdom too.
That's a perfect thought to end on. Start small, learn as you go, and focus on what you understand. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.